Hello everyone, and welcome to our yet another very interesting lecture on property income. My name is Innocent Mugisha, and I'm going to take you through this particular unit and move to our chapter 4 and try to follow as I guide you through this particular unit. In this unit, we are going to talk about the property itself. We shall define a property. We shall talk about the types of properties. We shall move into the definition of property income, which is the subject of this course unit for today. We shall talk about the taxation of our property income in general terms. Okay, we move into the definitions of property. Something to note here is that the Income Tax Act Cap 340 and the VAT Act Cap 349 of the laws of Uganda has not put up a definition for property, but a number of scholars have come up with very nice definitions of what would be property. One of the definitions that has been put across, where you see my cursor here, is that property is a physical or intangible entity. Okay, a physical or intangible entity. Intangible, remember, something that you may not touch, doesn't have a physical form, that is owned by a person or jointly owned by a group of people. You can go through this again. We are saying that property is a physical or intangible entity that is owned by a person or jointly by a group of people. So this is our very nice definition here that is going to guide us in understanding how people use these properties to derive income that in return is taxable in their hands. So from the definition of property as an entity, it is very important to understand the unique characteristic of our property. So on slide number 10, we move into the characteristic of property. So here we are saying that depending on the nature of the property, an owner of the property has the right to consume, sell, rent, mortgage, transfer, exchange, or destroy it, or the owner has the right to exclude others from doing the same. So this is a very important and unique characteristic of a property. You as the person, you as the owner, you have the right to consume the property, you have the right to sell the property, you have the right to rent the property, you have the right to mortgage the property, transfer the property, exchange, or even very interesting, destroy it, or to exclude others from doing the same. So it means that this property, if it is going to derive income, you are the sole person that is going to receive and enjoy these economic benefits. Or if it is going to bring you a loss, you are this sole person that is going to suffer the loss. So you as the owner of the property, you have the right to this property. Of course, we shall see other very unique characteristics of property. Next, after understanding the characteristic of a property from other entities, it is important for us to understand some of the widely recognized types of properties. Okay, widely recognized types of properties. Number one, we have what you call the real property. Real property in this case is the combination of land and any improvements to it. Okay, any improvements on the land and improvements, the combination of land and any improvements on the land. Next, we have personal property. Personal property, here we are talking about physical possessions or belongings to a person. Physical possessions or belongings to a person. Number three, we are talking about private property. This is property owned by legal persons or what we call business entities. So these legal persons are persons or entities created by law, okay, like a business. Remember, in our financial accounting, we talk about the business entity concept, where we look at a business as a very different person from an individual or from the owner of the business. So private property are these properties owned by the business. Number four, on slide number 12, we are talking about public property. Public property, this is state owned or publicly owned and available possessions. State owned property. Remember, the government is also an entity that can own properties. So things like forests, roads, railways, electricity networks, telephone networks that belong to the government, these are typical public properties. Next, number 5, we have what we call intellectual property. Intellectual property, here we are looking at exclusive rights over artistic creations, inventions, etc. So intellectual property, you must have exclusive rights over some creations, inventions, or anything. Take an example of artists who have exclusive rights over their songs, over their tracks. The tracks they make, they have exclusive rights. You find cases whereby you do not have authority to play the track without the authority of the artist. So on our slide number 13, we move into something to do with the definitions of property income. Okay, definitions of property income. Of course, after looking at what is property, which we are saying is could be public property, we are saying it could be intellectual property, saying it could be maybe private property. So what is this property income? Of course, ideally, in simple terms, you would say property income is income derived from the consumption or from the use of the property. Yes, you could be right, but we want to root our definition from the Income Tax Act. So straight away, for those who have the Income Tax Act, you can move to this section, or for those who may not have a copy of this act, you can request for this act, or you can send it on your mail. You can request it on our Facebook page. You can go to our YouTube channel. We can send you in all forms of communication that are available to you. So according to section 20, subsection 1 of the Income Tax Act, property has been defined in a very, very special way. One, property has been defined as dividend income. Okay, property has been defined as dividend income, interest, natural resource payments, rents, royalties, and any other payments that you derive from the use or consumption of your property. So this is a very, very unique definition, which comes from section 20, subsection 1, part A of the Income Tax Act. This is not the only definition given, because this is only part A. This particular section or subsection has 3 major definitions of property. We are going to look at the other definitions, but before we move into the other definitions, we want to critically look at this definition in part A of subsection 1, section 20. So we are saying property income is dividend. So when you receive dividend, we shall say you have received property income. When you receive interest, in all ways, we shall say you have received property income. When you receive a natural resource payment, we shall say you have received property income. When you receive rentals, we shall say you have received property income. When you receive royalties, we're going to see what are these royalties. Okay, you may be wondering what are these. Okay, so we're going to talk about these, and then any other payment that may come in line with the exploitation and use of your property. So this is the very, very first definition under section 20, subsection 1 of the Income Tax Act. So section 20, subsection 1, part B, goes into property income as the value of a gift derived by a person. Okay, value of a gift derived by a person. I've tried to underline this. So we are saying when you receive a gift, the value of that gift is actual property income, and this is indeed taxable in your hands. Okay, so you have to be careful where you receive your gifts. Subsection 1, part C of our Income Tax Act brings in another very, very special definition of property income, and it says that property income is the total amount of any contribution made to a retirement fund during the year of income by a tax-exempt employer. So what are we looking at here? We are looking at that contribution. This word, this underlined word here, that's where I put my cursor. That contribution that has been made to a retirement fund. An example of a retirement fund is our NSSF. Now, NSSF, your employer is going to contribute 10% to this fund. So that 10% is actual payment in kind. This is looked as property income. There may be other forms of funds, but that could be a special fund for you where your employer contributes in interest of the services that you provide for them. So this contribution is looked at as property income. So in a nutshell, we are saying property income is dividend income, interest income, natural resource payments, rents, royalties, value of gifts, and any contribution to a retirement fund. So after delving into the definition of property income, the question is, how is this income taxed? Okay, how much is going to be taxed? And this is one of your biggest worries: how much is going to be taxed? How much is going to be taken away? So we move into this very other interesting unit or part of our property income. So slide number 24 presents to you the various ways in which property income is taxed. But starting off with this first bullet, we are saying that property income can be earned by all given types of persons defined in the Income Tax Act. It can be earned by individuals or by incorporated bodies like companies, trusts, or partnerships. So a partnership can earn property income, an individual can earn property income, a company can earn property income. So the way the taxation is going to be made is going to depend on who is receiving this property income. If it is an individual, we are going to see very different treatment. If it is a company, we are going to see very different treatment. If it is a trust, we're going to see very different treatment. If it's a partnership, you're going to see a different treatment. So all of these persons have different treatments when it comes to taxation or property income. So straight away to slide number 25, we shall start with the individual. Remember the definition of an individual as per the Income Tax Act. This is a human being. A person can, a human being, somebody who is breathing, in other words. So what happens to a human being with the earned property income? So on slide number 26, we are saying that property income earned by an individual from a resident person, with the exception of rental income, will in most cases attract a withholding tax at a specified rate of 15% or 10%, depending on the source of income. So here we have some very, very special words that I want to highlight to you. Very, very unique words here that I would like to highlight to you. You can follow where my cursor is. We're talking about property income earned by an individual from a resident person. Okay, from a resident person. So remember, the human being is you. So you've earned property income. Remember the property income I talked about: dividends, interest, rents, natural resource payments. So you have earned the property income from a resident person. Remember the definition of a resident person. We have talked about this in our previous lecture. We have said that a resident person can be a resident individual, can be a resident company, can be a resident partnership, and these have been clearly defined. So for those who may have confusion on what is a resident person, please try to download our lecture on resident persons. So if you have received from a resident, ideally a resident person is a person. Let's talk about a resident company. Resident company would be a company that is registered in Uganda. Management is in Uganda, operations are in Uganda. So if you receive a dividend from a resident person, a resident company, that dividend is going to be taxed at 15% or 10% by way of withholding. So this is a withholding tax. And what is the meaning of a withholding tax? Withholding tax is the tax that is charged at source. Okay, charged at source. It is withheld before the payment is made to you. So you will receive your property income net of this withholding tax. Now we are talking about these rates, 15% and 10%. Who pays at 15%? Who pays at 10%? Now, who pays at 15%? 15% ideally would be a company that is not quoted, a company that is not listed on the stock exchange. As we shall see in our next lecture, taxation of dividend income, withholding tax is paid at 10% if it is being paid from or by a company that is listed on the stock exchange. For example, DFCU Bank is listed, Uganda Clays is listed, Vision Group is listed. So when these companies pay a dividend to you, if you're a shareholder, then you're going to pay withholding tax at a lower rate of 10%. But if it is not listed, then ideally you pay withholding tax at 15%. So there are a number of categories of incomes that will be taxed at different rates. So on average, we are saying withholding tax is at 15%. Okay, withholding tax is at 15%. And we continue the second bullet by saying that the tax withheld at source is the final tax on such income of an individual. So if you are the individual, if an individual, the tax that has been paid at source, or the tax that has been removed before your payment was made, is the final tax. So it means that the income you have received will not be subject to further taxation. This is a very, very special and unique treatment of property income earned by individuals from, remember, resident persons. Let's continue to our slide number 27. Slide number 27 continues with the taxation of property income earned by individuals by saying that in the first bullet, according to section 122 of the Income Tax Act, any income which attracts withholding tax as the final tax shall not be included in the gross income of that person for tax purposes again. And then in bullet number 2, we are saying this therefore implies that property income of an individual which attracts withholding tax as the final tax cannot be included in the gross income of the individual for tax purposes again, as the withholding tax as source is deemed to be the final tax on such income. So this is the relief to you if you're an individual. The withholding tax you have paid on your property income is the final tax. And this is the law, which is saying that we are not going to gross it up again with any other income. Now, assuming you have earned employment income, we are saying that we're not going to gross up your employment income with your property income. This tax is the final tax. So no more taxation that is expected or should be made on this income if the individual has already paid their withholding tax in the property income. Let's continue. Slide number 28 puts a note that this provision is only applicable to property income earned from a resident person by an individual. It does not apply to property income earned from a non-resident person, even if tax held at source by the tax was held at source by the non-resident person. So what do we mean by this? Here we are saying that if you are still an individual, if you are an individual and you earn property income from a non-resident company, for instance, the property income you've earned is going to be subject to further taxation. Okay, the property income is going to be subject to further taxation. But of course, there will be issues of double taxation, because here we are saying that even if the tax was held at source, we are going to tax it again in Uganda. However, there are some other provisions where you get a relief for any foreign withholding tax paid. Of course, we are going to move into that when we try to look at our dividend income. In our next lecture, you'll be able to download that lecture. Our dividend income, taxation of dividend income, taxation of interest income. We are going to see how you may be able to claim a relief from URA if you earn property income from a non-resident person. So these are some of the very, very special treatments of property income that you need to note before you move into your examination. Next, we can move into slide number 29, where we're talking about property income earned by an individual from non-residents. So how is this treated? Of course, already we have got a hint that it will be again grossed up. So in bullet number 1, we are saying that where property income is earned from a non-resident person, it is treated like any other business income. Therefore, it will be aggregated together with other sources of income and taxed at the individual tax rates, which we ideally call the pay rates. Any tax withheld by the non-resident will be regarded as tax paid in advance, and this will be reduced from the tax payable by the individual. So what does it mean? Subject to the double taxation rules, you receive a relief. So we are going to get the gross of your property income earned from a non-resident. Remember, I'm giving an example of a non-resident as a foreign company. Assuming you have shares in MTN South Africa, and MTN South Africa pays a dividend, of course, MTN South Africa will withhold some of the dividend income that you're supposed to earn because of the tax rules in South Africa. So we are saying that no worries, if you have paid foreign withholding tax, this is going to be deducted before you finally pay your withholding tax in Uganda, or before you pay your business or corporation tax or whatever in Uganda. So these are the treatments of property income earned by an individual. We can move into the property income earned by a company. So here in bullet number 1, slide number 31, we are saying, although property income earned by companies will equally attract withholding tax at the same rate like the individual, such withholding tax will not be the final tax on such income. Interesting. So you're saying that for companies, it's not the final tax. We further subject that property income to corporation tax. So in bullet number 2, we are saying in this regard that this implies that such income will be grossed up with other sources of income of the company and subject to a tax at the corporation tax rate of 30%. So this is actual double taxation. You've already paid your 15% withholding tax at source. Again, we are saying we are going to tax the gross at 30%. However, in bullet number 3, things seem to be made easy for you. We are saying that the withholding tax deducted at source will then be given as a relief from double taxation or as a tax credit. So this now makes things a little bit simpler and lighter for you as a company, because you'll be allowed to deduct the withholding tax you paid from the tax liability before you take the check to URA. So before I take the check to URA, I'll ask myself how much has been removed as withholding tax. I deduct that and then take the balance to URA. That is very, very interesting. So we are going to see all these in the exam, but of course, I want you to note these very, very unique special treatments before we move into the exam type question. So with that, of course, I would like to thank you for being with me here and attending our online lectures. Remember, we have put up this channel to help you improve on your performance, to help you pass the paper on first attempt. Of course, there are a number of testimonies. You can go to our Facebook page and check these out. But we continue to assure you that we are dedicated to this project, and we shall try as much as possible to give you all the updates and all the lectures online. With that, my name is Innocent Mukisha, facilitator today. Have a good evening.